still a big believer. I'm old school. I believe that technical analysis is still extremely important, and finding directional buyers. There's not a lot of EAs out there, expert advisors out there that can help you actually identify directional buyers, because you have to apply some technical analysis. You have to do that. But where I use automation is I first define the directional bias by using technical analysis. And then once I establish what the direction is going to be for the short term, long term, whatever that may be, then I use automation to deploy it in that direction. So I don't have to sit in front of the computer waiting for the things to happen. The automation does it for me, but I know at least I'm looking for just buying sentiment or selling sentiment, and that's what automation is.
Would it be accurate to say that you use automation much more as an execution tool rather than an analytical tool?
Absolutely, that's exactly what it is. Yeah, automation is execution, and then of course the directional bias is technical.
When you say you create a bias, are you a long-term trader, intermediate-term trader, short-term trader? What's sort of your sweet spot? Where do you operate best?
I believe in having the three different types of, or at least two. You've got to have your bread and butter trades. So I do intraday trading to go ahead and generate day-to-day profits, because one thing about a trader, he always likes to see things, he likes to see growth in his account. Now, I started off as a scalper back in early 2000. And I struggled to move into a swing trader because I was so used to taking profits quickly. So what I had to do is I had to find the happy medium. So I set up a trading accounts that would bring me bread and butter trades, which is short-term trades, but then also started looking at long-term trades. So I satisfied both needs. And so your question, what type of trader I am, I'm a trader with short-term and long-term. So when I look at directional bias, my directional bias will be maybe mid-term directional bias, but that helps me with my short-term trades, because as long as I know where the market's going mid-term, the short-term trades, if I get it wrong, I use a cost averaging strategy. So even if I'm wrong, I can get in on multiple positions, but eventually the market will go in my favor because the direction is still there. And that's important.
So would it be accurate to say that you have a long-term bias? If you get you try on the short-term side, on your scalping side, you stay faithful to that bias. If the trades are going against you, you're perfectly comfortable adding to the position as long as your long-term bias stays in place. And if you can't, if you can't sort of roll the profits on a quick short-term basis, you'll let those positions sit a little bit until they come back into money, and obviously average into position and just roll them afterwards. That's sort of your
absolutely. And the whole thing here is like the reason why I use cost averaging, so I don't have to be correct on my entry point first time around. So if I'm wrong on my entry point, and in most cases there's like a typical example, if I get a midterm bias on, let's say, US dollar CAD, and the short term is still selling off, then what I do is I look for the short term to change trend. Once the short term changes trend, then I'm buying on the dips going in the direction of the midterm direction. And if, let's say, for instance, the short term goes further down south, then I hold off and then look for levels of support to rebuy back in again, so that if the market does go back up again, I can make a decision that, hey, was I wrong? Do I need to get out of this trade, or do I continue to hold this position? But at least I've locked in some more positions so that I can make maximum profit to the upside. So now, is there a limit
to how many positions you'll assume? And is there a formula you use in terms of, like, is it a third, a third, a third, a quarter, quarter, quarter? Is there sort of a rough estimate of how you would enter positions so that you don't spend all your capital at once?
That is a great question, because a lot of traders struggle with this, and that is, of course, managing their risk correctly.
Yes.
And what happens is, you've probably heard the term, ride the wave. And we also, no, you don't ride the wave. You have stops to protect yourself. But the thing here is, you have to be able to ride through the drawdowns. You have to be able to sustain yourself through the drawdowns. So how I manage that is, any strategy I use, I look at what is the risk that I'm looking at applying to that strategy. But before I do that is, I take my account my portfolio, and if I'm managing money or I'm trading my own account, what I do is I take 40% of the capital. And out of the 40% of the capital, I then manage the risk to chase after anything between 2 to 5% return monthly. And so it is higher risk, but it's also 40% of the capital. And so if I do get into drawdowns that I need additional capital, the 60% that's balanced,
Right.
that's my buying power to get me out of those positions. So
you effectively sort of put 60% of your money into a lockbox,
yes,
and only allow yourself to use 40% of your available capital, so that when push comes to shove, you have ample firepower to adjust your positions.
Absolutely. And what I also do is that 60%, I like to keep seeing money tick over. So I would like to see returns keep ticking. So what I do is I apply a very, very conservative strategy to that, so that I'm getting growth on the 60%, but it's very low. But at least I'm managing the other growth, so that if I ever need to get more capital, I haven't exposed myself too much on the 60%, that I can move money into the other 40%. Yeah, the one thing I've really learned through the years, and trust me, I've made my fair mistakes, but the one thing that I've really learned through the years of trading is that trading is all about managing risk. If you can manage your risk, it doesn't matter if you've got a great strategy or bad strategy, you will still come off on top. Whether it's a small profit or it's a lot of profit, that'll depend on the strategy itself. But what's important is how we manage the risk, because you can have a great strategy, and you know that you've been trading a long time too. You can have a fantastic strategy, great strategy that's got a strike rate of about 80%. But if you don't manage the risk properly, you're just not going to see the fruits of that strategy, because you're never going to be able to survive through the drawdowns. My portfolio, I have 100% of my portfolio is split into three areas: cryptos, forex, and stocks. All right, and I've got 60% of my capital. Actually, no, I lied. 50% of my capital in stocks, in long-term stocks. But then I've got 30% of my capital actually in cryptos, and 20% in forex.
Wow.
And it's strange, because I was so involved in invested into forex for such a long time.
Right.
Yet I'm now moved 30% into forex, into cryptos, and 20% into forex. Right. Well, the reason for that is, Boris, because there's just so much opportunity. You see, I got involved in cryptos back in 2016 at a very low scale. I wasn't completely bought in. In fact, I was introduced in 2010, and I never got involved. And one of everyone's got a time in their life.
Don't you feel sorry now?
Yes, everyone's got a time in their life they go, man, if I just took that $5 grand and I just bought what I wanted to do, because I did. I was literally at the machine, because they didn't have apps that you can do right now. It was a machine. I was going to put money in and get Bitcoin out. Right. And I never did that because it was just too much of a hassle.
Right.
But in any case, when it started becoming more popular in 2016 and 17, I got more involved in that, and I started getting more invested. But bought a lot of Ethereum and Bitcoin. I did mining. I mined the coins as well. I didn't do too well when Bitcoin dropped below 10,000, but I did that as well, and I continued to trade Bitcoin. But at a point, I actually looked at, I started getting more involved in the technical side of it, because, if you go into the internet, you look at a lot of these gurus in cryptos. A lot of them don't really understand charts, and understand that cryptos is more of a hype, a pump and dump type of strategy. But the thing here is, cryptos is we've got enough information now on the charts to be able to be technically minded in understanding what the markets are really doing. I've been breaking down charts from a technical perspective on cryptos for the last year, and it's very predictable how you draw up the market swings. It's not something that is just a hype thing. There is hype, a lot of hype involved in cryptos, but there is this opportunity to be able to identify how the market's going to move in these different channels. And that's where the opportunity is with cryptos right now, but not just, a few percent. We're talking about cryptos offering 100% in a week. It's insane. Is that what you do is when you start seeing a technical setup, all you got to do is just go onto Twitter feeds and all types of social media, and you will start seeing the hype coming up on certain coins. And when that coin has been hyped up at a certain level, that's when you start buying in. That's when you really start buying in, because it's like everything. You're a news guy. I know Kathy's a news guy. But when you're looking at non-farm payrolls, and the non-farm payrolls are coming out on Friday, and they're expecting to see really bad numbers in jobs, and then you go to your technical chart, and your technical chart looks like on the US dollar CAD, looks like it's going to fall through the floor,
Right.
you definitely see correlation, right, with the
Right.
news and with technicals.
Right.
And that's the same with the cryptos. Cryptos is all about looking at the technicals to give you the warning sign saying, hey, something's coming up, but
Right.
we don't know what it is. But when you start reading up in the news, then suddenly there's these things that come
Right.
up and you go, okay, now I can see where the hype's all coming from.
Correct.
And now I can see how the technicals line up and connect.
Right.
A new startup business.
Yes.
Altcoins are like new startup businesses. I think it's the best analogy that I can come up with. And so what happens is with new startup businesses, you need people to buy in. You need an adoption, right? People to buy into that. And the same with altcoins. You need people to buy into that. So what you do is you watch a certain altcoin that is traded very low or very cheap, and then you start looking for signs of adoption. How many people are looking are interested in it?
Right.
And the more people are interested in it, that means that coin is ultimately going to start break out of levels. Now, if it's range bound levels, it's easy to trade. If it is a trend that's corrected itself, that's easy to trade. You know, so those type of things. But you have to use, unfortunately, with cryptos, in order to get those big moves, it's got to have adoption. There's got to be adoption behind it. And if there is, that's the momentum that you're looking for in order to be able to look for if it's going to go 100%,
right,
200%, 300, or 10x or 20x, whatever. You need to have the adoption behind it. And so when you look at a crypto and you're looking to trade a crypto, you have to define whether or not you're going to hold onto that coin for a short period of time to make profits and get out. And in most cases, I would say altcoins are short-term profit takers. You got to get in and out. Put your profits into Bitcoin and Ethereum. Those are your solid coins that you want to go ahead and keep holding. So you always got the holding base, and then you've got the altcoins that help you generate additional revenue. And then once you build up capital, you move that back into the majors.